Hey everyone, Ash here with the Better Than Yesterday blog. If you've been following the blog for a while now, you're probably aware that we like to keep things simple here. Simple is the best way for beginners to learn, especially when it comes to reading financial statements. When it comes to business, one of my biggest concerns is when business owners don't know their numbers. Of course, I'm not expecting people to memorize their numbers every waking minute. But if you don't have the ability to easily access your financial statements and actually comprehend what the financial statements are telling you, then you do not know your numbers. So how about we start at the beginning? So what even are financial statements? Basically, financial statements are reports that show the financial activities and position of a business. And if you Google it, the definition states that the financial information is presented in an easy-to-understand way. Just because accountants can easily understand it doesn't mean that everybody else can easily understand what the statements are saying. So let's change that. The three basic financial statements are the balance sheet, income statement, and cash flow statement. We are going to look at super simple statements because if you can understand the simple statements, then the complex statements will be much easier to learn later on. The balance sheet shows the book value of a company. This financial statement shows the assets, liabilities, and owner's equity. If any of you took an accounting class, you are aware that assets have to equal liabilities plus owner's equity. Okay, what does that mean? Assets are anything valuable that a company owns. Assets on a balance sheet are usually broken up into categories like current assets, fixed assets, property and equipment, or other assets. Current assets are usually cash, bank accounts, inventory, short-term investments, or anything that can be converted into cash within 1 year. Now, fixed assets, or property and equipment, are long-term investments, held on for longer than a year, and cannot be easily converted into cash. Some examples are land, buildings, and equipment. One thing to be aware of in this category is that there is accumulated depreciation that is subtracted from the asset's original value. So, for example, if you buy a $20,000 vehicle, as soon as you drive it off the lot, it is no longer worth $20,000. Therefore, you have to correctly report the vehicle's value on the balance sheet. If the vehicle's expected life is 5 years, then you would have a depreciation expense of $4,000 each year until you reach the original value of $20,000 in accumulated depreciation. So, after the first year of owning the vehicle, this is how your balance sheet would look. Well, other assets are basically just assets that don't logically fit into any of the other categories. Okay, let's move on to liabilities. Liabilities is just a fancy word for debt. This shows everything that the company owes. Let's use the vehicle example again. When our chef purchased that $20,000 vehicle, they paid $10,000 in cash and financed the other $10,000. So on their liability section on the balance sheet, they would have a current liability of $10,000. And just like assets, liabilities are broken up into short-term and long-term categories, usually referred to as current liabilities and non-current liabilities. All right, now on to owner's equity. Equity is the ownership of the assets and liabilities. This section contains retained earnings, owner contributions, owner distributions, and for corporations, common or preferred stock. But we're just going to focus on the first three today. Let's start with retained earnings. So retained earnings is the accumulated net income of the company that is retained. Did that sound like a foreign language? Okay, let me break it down with this example. So the first year, the company had a net income of $5,000, and the second year, it had a net income of $8,000. Well, since we're disregarding common and preferred stock, the total retained earnings after year 2 would be $5,000, plus $8,000, which is $13,000. Now, owner contributions and distributions are a little bit easier to understand. Contributions are when the owner contributes money to the company. So let's say that our chef transferred $30,000 of their personal money to get the business started in year 1. And then in year 2, our chef decided to take out $7,000 of company money for personal use. So basically, contributions are when the owner puts money into the company, and distributions are when the owner takes money out of the company. All right, now let's see what the balance sheet looks like. In the asset section, you'll see that our current assets plus our property and equipment net is a total of $46,000. In the liability and equity section, you'll see that our $10,000 vehicle loan plus our equity that we just went over also equals $46,000. So our balance sheet is in balance because our assets equal our liabilities plus equity. Now let's look at the income statement, otherwise known as the profit and loss statement. The income statement is a summary of gross revenue minus the expenses within a given period. The income statement includes revenue, which is what the company earns before any other expenses are taken, the cost of goods sold, which is the cost necessary to make supplies for whatever the business sells, and expenses, which is what the company spends to make the business run. You will also see gross profit and net income on an income statement. So what's the difference between the two? Well, gross profit is revenue minus cost of goods sold, while net income is gross profit minus all the other expenses. Net income shows what your business actually made in a given period. Last but not least, we have the cash flow statement. The cash flow statement provides details of what happened to the company's cash during a given period. The cash flow statement is broken down into 3 categories: operating activities, investing activities, and financing activities. The operating activities are basically what's on the income statement, which includes revenue and expenses of a company. So it's pretty much the net income on the income statement. Investing activities show the purchasing or selling of assets. So it's pretty much the property and equipment section of the balance sheet. And financing activities show the debt and equity financing for the company. So in other words, it's the liabilities and equity section of the balance sheet. And after completing the cash flow statement, the cash at end of period balance should match your balance sheet cash and bank account balance at the same given period. Wow, that was a lot of information. If you made it to the end without taking a break, I am so proud of you. Knowing how to comprehend financial statements is very essential to business owners. These statements are your lifeline when making business decisions. Take the time to fully understand the simple report examples put together in this video. Once you understand these simple reports, the complex reports will be easier and easier to digest. Don't feel bad if you can't grasp this information in one sitting. Take your time and keep learning. You don't have to figure it all out today, but do continue working at it. Just focus on understanding more than you did yesterday.